Hello, I'm David Scranton, and thank you for clicking this video. I'm here with Jeff Small, President of Arbor Financial Services. As usual, Jeff, it's always great to talk with you.
Great to see you, Dave. Glad to be here.
And today's special guest, Harry Dent. Harry's the editor of Economy and Markets, which is a newsletter, and it's available for free at harrydent.com. Harry, great to have you with us again, as usual.
Yeah, nice to be back, David.
Harry, just to keep continuing our conversation's ongoing saga, the markets, it's a spooky time calendar-wise, but the markets certainly are not acting spooky. With earnings up over 27% year over year and projected 2022 stock earnings to be 9.3% over this year, give us your best bull or bear thesis going forward. Tell us what you think.
Well, you know, you talk about spooky markets. The spookiest markets are ones that go up super fast, vertical. So we had that 95 to 2000 for 5 years, an almost vertical movement with almost no corrections. And we had it in 87 for 3 years, you know, from 84 to 87, straight up. And those things are always followed by big crashes because markets just cannot sustain bull moves like that. And even if there's some good things happening, good things don't sustain for that long either. So my problem with this, it's already pretty clear from every forecast I looked at. Yeah, we had a big rebound because of massive, trillions of dollars of stimulus, the greatest 1.5-year surge in stimulus ever, counting fiscal and monetary, way bigger than anything before. And now, just a year and a half into the recovery, the economy's rolling over. GDP forecasts keep getting revised down. The Federal Reserve, the Atlanta Federal Reserve just put out their forecast that GDP is quickly moving down to 1.2%. So if you stimulate this much and you only get a short move and the economy starts to weaken again, it shows that the economy's weak underneath. So the worst thing can happen be stocks bubbling up like there's no tomorrow because they've been doing it so long, and the economy being very clear that this means you're going to have a straight down market in the next year. So my forecast for 2022, straight down, maybe the biggest 1-year crash we've seen in our lifetime, more than 87, more than 2000, the first of that last big tech crash.
Sure. So Harry, I guess my question then is, what triggers it? Because just a revised lower GDP estimate doesn't seem to be doing anything. The market participants seem to have blindfolds on. So usually there's that one trigger that starts to spook the markets and then starts that downward slide that then just snowballs. So what's your best guess as to maybe the top two possibilities for the things that spook the markets to start the slide?
Well, a part of it, I think, they just you got to remember, most corrections get started by the smart money. These are the people that love they make money off the dumb money, which is most investors, okay? So they like to steer a market up, and when they think they look at what everybody's done. When they think that everybody's piled into this, and I'm telling you, everybody is piled into this. Consumer sentiment, investment sentiment, everything's at the top, whereas again, the economy is already showing clear signs of weakening. Doesn't matter. So they're all in. When these guys see this, they just start shorting it aggressively, and that's all it takes. Now, the thing is, when you're in a bubble like this, and this is why this is so important, it doesn't necessarily take a big thing. What happened when the Japan bubble burst in late 89? I used to ask people, what went wrong in Japan in late 89 that caused a 62% crash to come in the next 2 years? And the answer was, there was nothing. They just had a bubble so stretched that it finally started to weaken, and then it builds momentum on it. And so I don't think it takes some big news event. All I can tell you is the first crash, when a bubble finally has its first crash, it is 40 to 50% in 2 to 3 months. And my model is saying this one's going to be even worse, 53 to 56% in 2.5 months is what we're likely to see. So all it takes is this to weaken enough, and then the traders just say, oh, this is over, and it just goes. So it's not going to take, I don't think it's going to take a big trigger.
Harry, listen, we know the Fed has overstimulated the markets. The economy, $7 trillion of stimulus from last year is craziness. They're left with really bad choices going forward as the new addiction is stimulus for the economy to grow. But hypothetically, let's have some fun. Harry, if you were Jerome Powell, what would you do right now at the Fed?
Well, see, here's the problem. They're already trapped. When you stimulate an economy this long, you're getting an economy that should have shaken out, worked off a lot of bad. There's 22% zombie companies, technically bankrupt, but they don't have to default when there's easy money and low interest rates and no recession. And debt levels that are now a lot higher than they were already at the highest in history back at the 2007 top when that recession came in. When you just keep stimulating, then it takes exponentially more stimulus to keep a dead economy going. So if they just flatten here, whatever they do here, just taper, this thing is not going to be able to support itself. And the stocks are going to start going down, the economy start weakening, and they'll have to goose it up again. The problem is they've dug their own grave here. I think this thing is going to crash either after one more run into year end or in the first quarter, or it may just keep crashing here. But once it gets momentum, they're not going to be able to control it. And the way it happens, real simple, that first crash, 40 to 50%, you get a rebound when they do finally have a chance to react and do something stimulative again, but with a lot less credibility time. And then you get a 2-year plus grind down in stocks. Every major bubble burst has had that first dramatic crash, sharp rebound, and then a grinding downturn when people realize no, they're.
So Harry, I'll take that answer as nobody wants to be Jerome Powell right now. Nobody wants that job because
if I was him, I'd fake a heart attack and go disappear somewhere.
Okay. Well, I'm sorry I asked you what you would do then. Okay.
So you think it's a quick 50% drop next year, and then a slow grind down after that. So at least a slow grind down is more manageable. People can pick sectors and try to get the right sectors that might have a better shot of doing well. But that precipitous drop is the scary part. But still, how far down do you see it going ultimately before all this shakes out, maybe 2 or 3 years down the road?
Well, okay. First target, that first crash is pretty darn clear. The support in 2008 at best, about 2192. And my models say 2100. So 2000. So 2000 to 2200 is a good place for that first crash to happen. And that's right in that 50% crash range. Yep. And then you get a bounce just from it being oversold. I think what's going to happen here, which is going to be a bit unique, after this much stimulus for this long, and after they went 4.7 trillion versus in a year and a half versus 3.6 over 9 years before that, this much stimulus and it fails, the Fed is going to lose credibility here. People are going to realize what's obvious to me, anybody with common sense, you can't run an economy on printing money out of thin air forever and expect, I mean, if there's just a short-term crisis, then it should just take a year like in 2009, a year of printing $1 trillion. By the way, I would have approved that level of stimulus. Just get the economy so it doesn't have to just default unnecessarily and just melt down for no good reason. But you do need to restructure debt if you're going to go forward. They never did that. So the next downturn should take us down. My target is down about 80 to 85%, down to about 600 to 1,000 on the S&P. So first target, 2,000, 2,200, bounce up maybe back towards 2,800, something like that, and then you see that grind down to 600 to 1,000, and that should be over by late 2023. Be my best guess.
Wow, Harry. Well, that gets us down to the lows in the middle of the financial crisis. I think we were 600 and something on the S&P. So
yeah.
Well,
go back to 2009 lows.
I know. So all I can tell you is, those are some spooky Halloween facts, and I know you're not doing it just because it's Halloween, and I think you're on to something in some ways. I hope you're wrong for the greater good, but I can't say that you are. But I look forward to having you back after the first of the year, and let's see how it's going. Harry, Jeff, thank you both for being back with us. Thanks for watching today's video, Scary Facts About Retirement. If you enjoyed this video, click the thumbs up button and give us a like, and make sure you subscribe to our YouTube channel for new content each and every week.